Hello and welcome to Module 14. Today we're going to be talking about operating income-based valuation, and this will lead us into a discounted cash flow analysis and an alternative method that will reconcile, and hopefully that'll provide a little bit of insights into the way that the cash flows discount back to a present value. So let's begin with learning objective 1. Identify equity valuation models and explain the information required to value equity securities. We looked at the dividend discount model in modules 12 and 13. In both of those modules, we were concerned primarily with the cash flows as applicable and consistent with our discount rates, and the dividend discount model takes into consideration cash flows to equity holders. And therefore, it's appropriate to discount those cash flows by the weighted average cost of capital. Nope, I just misspoke. It would be appropriate to discount those cash flows by the cost of equity. And then Module 14 discusses the cash flows to the firm, in which we would use that weighted average cost of capital. So in the dividend discount model, just quickly by review, the stock's value is based on the future cash flows to the equity holder. Those future cash flows are primarily dividends, and then the uncertain amount which will be which the shareholder will receive when they actually sell the stock. Now let's contrast that to the discounted cash flow model. Again, these are free cash flows to the firm. This is the most widely recognized, the most widely used, one of the most heavily tested concepts on the Chartered Financial Analyst exam. The discounted cash flow model takes into consideration the free cash flows to the firm. So these are unlevered free cash flows, or the cash flows that the firm would have generated in a without consideration of any debt. And as such, those are the cash flows that are appropriately discounted by the firm's weighted average cost of capital. The discounted cash flow model is set up to compute the firm's enterprise value. That's the total value of the firm, and from that we'll subtract the company's net debt exposure to calculate the equity value of the firm, divide by shares outstanding, and we have an estimate of the price per share. That's ultimately what we're after with our semester-long case project, our research project. Once we have that number, we can compare it to the present price of the company, and if we have valued the firm at significantly less than where it's traded, or significantly more than where it's traded, then we have an opportunity either to buy the stock and profit as the future unfolds in a manner that's consistent with our forecast, or potentially bet against the stock by shorting it and watching maybe the future unfold in a little bit more of a pessimistic manner. So Module 14 contrasts the discounted cash flow model to the residual operating income model. A slightly different approach, but substantially similar. The residual operating income model uses net operating profits after tax and net operating assets to determine equity value. This approach highlights the importance of return on net operating assets. You'll recall that from Module 4, and the disaggregation of that number in net operating profit and asset turnover. Let's look at the module equivalency. This is a concept which we'll go a little bit deeper into in Module 14, but it's important to know at the outset that these two models are substantially equivalent, and under most circumstances they should lead us to the same conclusion. When the dividend discount model was introduced in Module 12, we saw this basic formula, meaning that the intrinsic value of the firm at time zero, or today, is equal to the dividend in period 1 plus the intrinsic value in period 1, divided by 1 plus the cost of equity. Now, both the discounted cash flow and the ROPI models derive the same basic starting point, and therefore mathematically equivalent, and they follow the same basic structure that we've been working towards and with all semester. where we have these steps, and we began with modules 1 and 2, understanding the business environment and accounting information. Moved into the what I call the meat of the course, modules 3 through 10, really, which was the heavy accounting. We had to really dive deep into the accounting to understand how that accounting and the estimates and the forecast and any discretion that management had to make judgment calls influenced the numbers that we were using to forecast future cash flows. After any necessary adjustments, we could make our best educated guess at what we felt the future was going to look like, and that was really forecasting financial information in Module 11. And then finally, during the last 3 weeks of the semester, we discuss basic valuation techniques, which allow us to take all that information and actually do something with it, and actually do something actionable with it. And that actionable component is what our research project's all about. Okay, let's move into learning objective number 2 here. Describe and apply the residual operating income model to value equity services. Equity securities, excuse me. Okay, great. Well, let's start with the ROPE model and the basic equation where firm value equals the net operating assets, which is comparable to the book value of equity. We're going to look at the balance sheet and take a look at the net assets, so the total assets minus any debt. And we're going to add the present value of expected return on operating income. Okay, so let's look a little bit deeper here at some terminology. The net operating assets are the foundation of firm value. Again, I mentioned that was comparable to the book value of equity. And to that, we're going to add, adjustments to the second term that correct for any possible undervalue or overvalue of net operating assets. So this adjustment is the present value of expected residual operating income, and is defined with this formula here, which we see highlighted. ROPE equals NOPAT, net operating profit after tax, minus the net operating assets times the return W there. Subscript W is the weighted average cost of capital. So that's our expected NOPAT. So net operating assets at the beginning of the period times our weighted average cost of capital. And we're going to break that down so it becomes a little bit more clear. But basically what we're doing is we're taking the value of the company as indicated by the balance sheet. And you might even think about that as like a liquidation value. If we just sold everything, how much cash would we be left with? Okay, so there's real value there. And to that number, we're going to add all of the value that we expect in the future. Now, if a company returns precisely its weighted average cost of capital, well, then that should indicate a intrinsic value that is identical to the publicly traded share price. If a company yields a future value that's greater than its weighted average cost of capital, then we should see a mismatch between what we calculate as a company's intrinsic value and its share price. Let's move on to slide number 10 here and look at that in a little bit more detail. So slide 10 breaks this down. Residual operating income is the net operating profit a firm earns over and above the return that operating assets are expected to earn given the firm's WACC. And again, you see that word expected highlighted there. So shareholders expect the company to generate that hurdle profit, or which would be the net operating assets times the WACC. Now, to the extent that a company can earn profits in excess of this, we refer to those profits as residual income. That is the income earned over and above the minimum amount of return required by investors. And there again, the return required by investors is a formula whereby we take the net operating assets and we multiply those times a company's weighted average cost of capital. In slide 11 here, we see the basic formula, or basic steps that we go through in using the ROPI model. To apply it, first we need to forecast and discount ROPI for the horizon period. We've already forecast our financial statements in Module 11, so we should have built that out already. Step number 2 is to forecast and discount ROPI for the terminal period. So very similar to the way that we discounted the dividend discount model and the discounted cash flow model. We have a horizon period and we have a terminal period. So then we're going to add together, we're going to sum the present values from both the horizon and the terminal period and add that to the current net operating assets to get enterprise value. So all of the excess valuation that a company has yielded over and above what we expected the company to generate based on the weighted average cost of capital, we're going to discount back to time zero. We're going to subtract the net operating obligations along with any non-controlling interest from the firm value, that exactly like we do in a discounted cash flow analysis. And then we're going to divide firm equity value by the number of shares outstanding to yield a value per share. And again, steps 4 and 5 there are identical to a discounted cash flow analysis. Okay, and we can see those steps applied here on slide 12, whereby the authors give us an example of Procter & Gamble. They have a forecast period from 2017 to 2020 laid out for us, where Procter & Gamble's sales grow from 65 billion to 70 billion. We have NOPAT calculated. We similarly have net operating assets calculated. With net operating assets, we can calculate net operating assets at the beginning of the period times our WACC. We can calculate what we expect to be a company's return. Now, when we take NOPAT and we subtract that expectation, we get a residual operating income. That residual operating income, which in 2017 is 7.6 billion, is the number that we will discount back to time zero. And the authors here are giving us a discount factor for each year between 2017 and 2020. We can also use a financial calculator or Microsoft Excel is what most analysts would use. That gives us a present value of this ROPI calculation in each year out through 2020. And then we similarly have a terminal year calculation. Discount the present values of years 17 through 20. Discount the present value of the terminal calculation. We're going to add the net operating assets to get a total firm value. Subtract net operating obligations less non-controlling interest to calculate firm equity value. Firm equity value here, 265 billion divided by shares outstanding, yields a price per share based on this ROPI model of 99.39. We'll compare that to Procter & Gamble's actual price today to determine whether or not P&G is overvalued or undervalued. Slide 13 here talks about a few of the differences between a discounted cash flow model and a ROPI model. In this instance, they yield identical stock price estimates, and our authors give us an example of when we can expect that to hold. You know, the ROPI model and the DCF models are close here, and that will hold in a steady state environment. That is when both net operating profit after tax and net operating assets are growing at the same rate, such that the residual net operating assets is the same every year. Now, when that steady state condition is not met, the two models will yield different valuations, and we primarily meet that that steady state expectation by having a sufficient forecast period or a sufficient time horizon. There's a theory that says that a company can only earn returns in excess of its cost of capital for short periods of time, because returns in excess of cost of capital will always attract competition. If you're earning an unusually high rate of return, which a return in excess of your cost of capital would count as an unusually high rate of return, those circumstances can persist in the market for a short period of time, but eventually you'll attract competition, and the competition will compete those margins away. Now, what we look for as investors are companies that can do exactly that, and we break that down according to our 4Ms: management, mispricing, moat, and mark. Well, that's moat. What kind of moat does a company have? What kind of competitive advantage does a company have? What kind of barrier to entry? Those are all different forms of the same thing that would allow a company to compound its margins at a rate that's higher than its weighted average cost of capital for many years into the future, a sustainable and lengthy period of time. That's what we look for as investors. And when we find that, the Ropey model and the discounted cash flow model may yield different price targets, and that's okay because they both give us insights into how a company works, and we can use both estimates to triangulate in on what we think is most appropriate for the given company at hand. And our authors touch on some of those differences here in slide 14. When we have differences between a discounted cash flow model and a Ropey model, we can make adjustments to our horizon period, for example. We can extend that to our growth rate, for example. If we haven't used a horizon period that takes us out to a sustainable growth rate, then both of those two things might work in tandem. Financial statement forecasts, terminal growth rate, these are all things that we have discretion over as analysts. We can do sensitivity analysis using one model or the other model or both models. And again, all of these inputs give us insights into the present value of the company that we're looking at. And on slide 15 here, our authors talk a little bit about sensitivity analysis. It's our job as analysts to be familiar with just how sensitive our forecast, our price target, our ultimately our value and our work is to each of these inputs that we're using in a discounted cash flow or a Ropey scenario. That weighted average cost of capital will always be one of the more sensitive inputs to our model. Typically, the terminal year growth rate will be one of the more sensitive inputs, and then our profit margins that we use in our forecasts are typically one of the more sensitive forecasts as well. Our authors make the point that these payoffs are assumed to occur at year end and are discounted for the entire year. Alternatively, you could assume that these payoffs are occurring evenly during the year or at mid-year and make adjustments for that accordingly. In practice, I've never actually seen that. The whole exercise of a discounted cash flow and forecasting financials into the future is by definition uncertain, and the best that we can ever really hope for is to be directionally correct, which is why when we do this, we try to apply an appropriate margin of safety to compensate for the natural error that creeps in when you're trying to predict the future, because that's an inherently uncertain endeavor to begin with. So to use mid-year cash flows is, I consider it to be a little bit of false precision. Nonetheless, it is worthwhile to point out that the assumption that all cash flows assumed at year end is not precisely what's going on there. So just be aware, be familiar, use some common sense when you're applying these models. Another technique that's often used, the authors here say that this is used as an alternative to sensitivity analysis, but I like to use it as a complement to sensitivity analysis, which is reverse engineering. And that's to take the Ropey model, take the discounted cash flow model, whatever you're using, and plug today's stock price in as the equity value, and then reverse engineer the model to basically solve for the weighted average cost of capital that would be necessary, or the terminal growth rate that would be necessary, or the profit margin that would be necessary to justify that stock price. And it's looking at the same problem through another lens. And we all know that sometimes when you change the perspective just a little bit, you get new comparisons to peer groups, to historical averages, so on and so forth, that make you a little bit more knowledgeable as an analyst and a little bit better prepared to defend your thesis. So consider that technique as well. Learning objective number 3, explain the relevance of steady state for valuation models. This was one of the differences between the discounted cash flow and the ROPE models. You'll recall that they were substantially similar when we had a steady state environment. So now let's explain the relevance of that in a little bit more detail here with learning objective number 3. So let's set it up here with slide 19. You'll recall that in Module 13 and then again in Module 14 we computed a price per share for a Procter & Gamble of 99.39. That was the same estimate with both models, discounted cash flow and ROPE. Now that doesn't mean that they are the same in terms of ease of use, but we did note that for those two prices to be equal, we had to be in a steady state. So let's understand with a little bit more precision the definition of what it means to be steady state. You'll see here on slide 20 that models like the discounted cash flow model and ROPE model, they tend to favor large, mature, predictable companies. And that makes sense because the more predictable, the more accurate we can be in our financial forecasts. And the more accurate we can be in our financial forecasts, the more accurate our present value is going to be. So let's look at this list here. First bullet, the longer the forecast horizon, the lower the precision of our model assumptions. With P&G, Procter & Gamble is a mature company. They don't have a long period of excessive growth in front of them. They're going to be growing at rates substantially similar to overall GDP. They're chugging along with global GDP growth. Nothing wrong with that, but they're a mature company. You take another upstart, Facebook in 2006 or Microsoft in 1982, depending on where the company is in its growth cycle, it could have a 20, 30-year run of excess growth. Well, if that's the case, then you're not going to reach your steady state, which you can think of as being your mature company, for a very long period of time. And that makes your forecast period very lengthy, and it also substantially lowers the accuracy of your model and the assumptions that go into that model. So because total estimated firm value, and I'm on the last bullet point here, because that total firm value is the sum of those individual present values over the horizon and terminal periods, the longer that horizon, longer that forecast horizon, the more confidence we have in total firm value and our stock price period, or rather the other way around. If we can get the substantial portion, meaning the larger components of that forecast in the early years, then we can have more confidence in that estimate. But to the extent that you're working with let's just say a Microsoft in 1982, well, most of your value is out 10, 20, 30 years, and those estimates are inherently very suspect. This next slide supports that conclusion as we look at the accuracy. The discounted cash flow model puts more weight in cash flows that are further out, and because of that, we have less precision in the estimated firm value. You can see that here. Present values with the DCF model, or discounting cash flows from 17 to 2020 with $241 billion in the terminal year. The ROPE calculation puts $70 billion at time zero. That doesn't need to be discounted at all. These are the net operating assets. And then the residual operating profit is much smaller in each year, and the terminal residual operating profit is substantially smaller. And therefore the cash flows that generate that estimate they're closer to time zero. They're more current. And because they're more current, we can have more confidence in both their accuracy and their precision. Okay, so again, achieving steady state. The discounted cash flow in the ROPI models will yield the same value if steady state is achieved. Steady state requires three things. Sales are growing at a constant rate, so you have a mature company. NOPAT for each dollar of sales is constant, and net operating assets required for each dollar of sales is constant. All of those three things are hallmarks of a mature company. So again, this works well for a company like Procter & Gamble. The critical issue here is not choice of model, but whether the forecast horizon is long enough to achieve a steady state. And this is another reason why I've set up the model templates for our case project as being 10 years in length. 10 years is typically enough time for most firms to reach a steady state. Not all firms. Some firms you'd have to go out more, but for most firms it gives us a good forecast period, a forecast horizon. On slides 23 and 24 here, our authors give us an example of a firm that's still early on in their growth curve. Their margins are fluctuating, their growth rates are fluctuating. If you have a shorter term horizon, it's very easy for a DCF and a ROPI model to yield different results. And here they aren't too far off, 893 and 912. But if you take that out just a little bit further, and in this example the authors just take it an additional year to reach that steady state, we can prove out through the numbers that the value would indeed be identical. So whether or not you have to go an additional year, an additional 5 years, or an additional 10 years to reach that steady state, once you've reached that steady state, then these two models will produce identical values. Learning objective number 4. Explain how equity valuation models can inform managerial decisions. Well, I think the answer here is all about perspective. We can use the discounted cash flow model, and we can use the ROPI model, and we can run sensitivity analysis, and we can reverse engineer concepts like WACC and growth rates and margins, and all of these things give us perspective on what's really going on inside of the company. So if we're familiar with the way that the ROPI model works, then we recognize that it ties firm value to net operating assets plus that residual operating profit, and managers can increase ROPI in one of two ways. We can decrease the net operating assets required to generate a given level of residual profit, or NOPAT, which is a matter of improving efficiencies inside of your firm. Or we can increase the NOPAT number with the same level of assets, which is to improve profitability. So we can look at pricing and turnover and other operating metrics to try to increase that total firm value. Achieving better performance requires effective management of both the balance sheet and income statement, which is your efficiency and profitability here. Focusing on that first component of reducing net operating assets required to generate a profit, and we're going to look at things like reducing receivables, reducing inventories, increasing payables, reducing property, plant, and equipment. And as a part of your research projects, you should know what these numbers look like, profitability numbers, turnover ratios, so on and so forth, from module 5 or 6, I believe it was, and how they compare to your competition. So if you have some peers, some competitors that are consistently more efficient than the company that you're looking at, find out why. As an analyst, you should know what other companies are doing right, so that you can ask your company what their plan is to do just as well. And if they have plans, if they've made investments in property, plant, and equipment, or they've made investments in manufacturing facilities or sales staff, then it would be reasonable to factor that into your long-term forecasts. So now we're back to module 11. Once we have all this information, we can make more accurate forecasts. Increasing NOPAT. For this exercise, we're looking at increasing gross margins, better product mix, reducing raw materials, labor costs. We've talked about all these things this semester. Module 14 with some of these discounted cash flows and ROPI models are just putting it all together. And then slide number 29 here, just star this one a couple of times. This would be a good reference for you to come back to, and when you're trying to remember the advantages and disadvantages of each model. The authors do a real nice job of basically summing up the whole chapter for us. So dog ear this slide and come back to it. I won't belabor the points here. We've touched on all of these as we've worked through Module 14, but this is just a great slide for future reference. And then lastly, on slide 30 here, our authors mentioned that there are other equity valuation models in practice, and the two that they mention here, and this is not an inclusive list by any stretch, but there's a method of comparables model. So this predicts equity valuation by using price multiples. If we look at P&G was the example that the authors used here in Module 14. If we look at Unilever, one of P&G's largest competitors, if they're trading at 16 times earnings and P&G is trading at 15 times earnings, well, you might argue that those companies are so substantially similar that they should have the same price multiple. And if that were true, then you could forecast P&G's stock price based on Unilever's current multiple. Though you see those types of valuation models, and they're very common. The net asset valuation model is another one that the authors list here. This would be to basically take the value of all the assets on hand and calculate what a reasonable buyer would pay if they had to go out and duplicate a substantially similar set of assets to generate the cash flows that are being generated by, well, P&G in this case. What would you have to do to generate those assets? And that can be a very worthwhile exercise for simple manufacturing firms. A company like P&G a little bit more difficult because you have to duplicate assets like the value that's inherent in a company's brand name, for example, and that can be difficult. But there and again, there's a right valuation model for every company, or there's well, let's just call it a best fit, and it's your job as the analyst to be able to know and differentiate and maybe use two or three and triangulate in on what you think is the most reliable, most precise, most accurate valuation model for your particular company. And that is the end of Module 14. Thanks for your time.